we do have an amazing panel. Of course, we're going to have them introduce themselves a little bit. But of course, just a little bit about our amazing moderator for this panel. He is the founder and managing partner of management consulting firm Block Zero Advisors. He's also a long-term entrepreneur specializing in the future of finance and payments through digital assets and blockchain. He's been focusing on blockchain innovation and the crypto economy since 2016. Awesome. Please give a hand for our amazing panel here.
Hi, everyone. So this is great to have this panel, so we'll jump right in. I'll take 2 seconds to set a bit the stage. I think this notion of stablecoin is known by most, as Alex likes to introduce the subjects. Usually we go through history, what they are, what stablecoin are not. But today we'll focus on why they matter and why they are not perfect. In 2023, just a few facts. Stablecoin issuance, sometimes we say capitalization, right? Market cap. I prefer talking about stablecoin as issuance, was $180 billion. The oldest stablecoin is $84 billion and is 9 years old. We have new entry in that space, PayPal, to name just a few. But more interestingly is the volume of transaction for the year. That is, sits right below $7 trillion, which is more than the MasterCard network has provided this year. That's how significant this is, and we'll try to get to the bottom of this. But we're talking about regulation, and there's regulation everywhere that is happening. New York Department of Financial Services, the accounting standard of American Institute of Accountants. Singapore has issued the stablecoin legislation. EU under the MiCA framework. UK has expanded their regulatory framework for stablecoins. Now, we're going to talk about fiat-based stablecoin. We agree we're there, right? And maybe we can start by one question is the use cases. And I'm trying to avoid like the notion of stability. I mean, intrinsically stablecoin are meant to be. We'll get to the risk in a second. So Adam, can you explain a bit what are some of the major use cases that we're seeing for those fiat-based stablecoins?
Sure. Thank you too much. Just a quick introduction about myself as well. I'm the CEO of Robo Group. We originally started from RoboCX, a Canadian trading platform, and also starting gradually global expansion as well. So stablecoin has been very important, I would say, digital asset class in our, exchange operating history. There are a few use cases I think are very important. So the first one, the most important and the most intuitive way is in asset is to hedge against the risks. So whenever you feel like the certain crypto assets at the top, you want to sell to it. A lot of times, you can sell to CAD or USD you like. But with the crypto native people, they typically tend to sell to the stablecoin so that they can keep the risk away, and whenever they feel like to trade it, they can trade again. So that's the most intuitive use case for that. So the second one, I think it's growing significantly in the past couple of years, is about payment and FX, foreign exchange related use cases. So if now you look at, the cross-border payments, leveraging stable coins, maybe between Asia and North America. So a lot of international trade has already been performed using stablecoin as a way of settlement. So you can literally get your stablecoin through your local payment rail, no matter whether in Asia, South America, and then you can transmit stablecoins to another country and over to sell to the local currencies using the local fiat gateways. So the whole process for that is much more efficient than any SWIFT wire transfer regime. And also a lot of times the cost, considering using stablecoin, can also be lower. So it's very cost-efficient ways to conduct international trade now using the stablecoin settlement, as well as a payment token. So I think that has been widely used. We're seeing more and more customers coming to us, not buying USDT, actually, sorry, not USDT, which is not allowed here. USDC, let me put it that way. Sorry, that's a mistake. So buying USDC, trying to settle globally, and they're not necessarily coming here for speculation. So third, I think it's also about stablecoin as a kind of entry ticket to go to the more kind of decentralized world. No matter you're talking about using it to do the staking, yield farming, and providing liquidities. So stablecoin has been a huge use case of that, and we have seen some maturities now for the DeFi market, not to provide crazy returns for these yield farming. It's certainly becoming more normalized. But stablecoin as a major asset trading pair, so it's definitely providing its base value over there. And also, for the recent upcoming very strong trend on the real world assets. So for the S2 exchanges, most trading pairs still would foresee to be conducting their fiat currencies. So however, for certain RW assets put on chain, I would say also the major trading pair will be actually against with stablecoin rather than more volatile assets to BTC and ETH. Because for the investment appetite and risk management perspective, those investors typically don't want to have the base currency to be so volatile. So that will be also another use case too. Yeah, I think these will be the main use cases for stablecoin, I think the use cases has been always expanding, and the trading volume for stablecoin has also been growing. No matter we're looking at it's bearish market or bullish market, the volume for stablecoin has been increasing in 2023, at least to what we can see.
Is it just the building of the infrastructure requires those characteristics? Is there high profile use cases? I don't know if someone else wants to contribute.
Yeah, absolutely, and I'll just do a quick intro of myself as well. I'm Alex McDougall, the CEO of Stablecorp. We're the issuer of the Canadian digital dollar, stablecoin, value reference crypto assets, nomenclature agnostic QCAD. I echo a lot of what Adam had to say there. We've seen a large growth of just the acceptance of this type of asset kind of globally. And obviously a lot of it's been driven by US dollar stablecoins, and a lot of the global volumes have been driven by US dollar. And we really think about kind of non-US dollar stablecoins as an additional connected fabric for local currencies that are kind of quietly important, like Canadian dollars. So whether it is in trading on regulated CTPs or in use in foreign exchange use cases, it's a new type of infrastructure that emerges and allows sort of the evolution past where the existing banking rails can let us down and have stopped evolving to a certain extent. We all see Cobalt and MUMPs and all the banking infrastructure that still sort of carries the day. And this is an opportunity to have some really new technology. But as we'll talk about, it's new, right? It's new structures, it's new formats, there's new risks that are associated with it. It needs new transparency, it needs new investor protection, consumer protection. And obviously, as it has grown explosively and grown out of an industry that is a new industry like crypto, the whole world is wrestling with regulation around this differently, and it's a very kind of hot topic and something that's highly relevant to right now around consumer and investor protection on stablecoins.
So we're seeing the infrastructure basically needing a stablecoin to actually exist and push forward the innovation. Stablecoins are there. Is that a proxy to what the rails could be?
But to a certain extent, you have native digital assets like Bitcoin and Ethereum that have sprung up out of this type of technology. And obviously, there's value fluctuation, there's fundamental value thesis of those is TBD, there's a lot of different things that are trying to be figured out. And stablecoins are sort of a way to plug in something that we mostly understand, a fiat-backed version of an asset, and just use the technology for all of kind of that, the ooey gooey blockchain magic stuff. But again, there's, that's not a panacea, right? It's a new use of technology with a new type of asset, and it's early days on a lot of these things.
Yeah, it feels that the innovation is really pulling the creation of that path, that innovation. We've seen some projects also that are not based in crypto, but that needs the stablecoin, like the UN's Taylor distribution in Ukraine, for example. But you point out on understanding what it is and the risks of this new technology. If we can look at how do we reduce technological risk? I mean, how do we identify technology risk? And then, the larger consumers, are they concerned? Are they to be?
Yeah, and just quickly on kind of the risk side as a whole, and this is something that the crypto industry in general struggles with, is the disclosure. Disclosure is the priority 1, 2, and 3 for how this stuff works and how this stuff will get to the next phase. And so monthly attestations, having the right structure in place for proper governance of the reserves around assets, and ultimately where that fits into securities law and where that fits into kind of the regulatory structures on a country by country basis. All of that is extremely important to how we create something that's not niche for just crypto native users, but for our financial institutions, for our scaled pension funds. So it starts with disclosure.
Global versus regional, I assume plenty of legal risk as well.
For sure. I was going to make a more general comment initially. I'm Alison Manzer. I'm a partner at Cassis Brock. And my interest in digital assets, and then particularly stablecoin, comes from a slightly different perspective than the others at the table. As a financial services lawyer for now 46 years, I've been watching increasing inefficiencies starting to bog down the industry. I've been watching difficulties in terms of particularly Canadian banks and perhaps the US banks being able to compete on a global basis because it was simply inefficient and slow. Right from the smallest of the micro issues, if you wish, when I was trying to deal with things such as the Filipino nannies who couldn't get the money, the $20 a week that was necessary for their families to survive in the Philippines cost efficiently and rapidly enough to the Philippines. I was looking at systems that were bogging down as we were trying to develop chain type of transactions, or we had to do back-to-back-to-back transfers which were necessary either for the transactions efficiency, for tax planning or whatever, and we simply couldn't accomplish it in the time frames and at the costs that were needed. So as I saw probably 9-10 years ago, I started gaining an interest in the use of digital assets to solve a lot of these problems, and we started working on a lot of projects. But we got hit very quickly with the big problem. And the big problem that we got hit with was no matter how fast we could execute using these techniques, the volatility was moving faster. And so we needed a solution that would give us a sufficient stability in the ability to value the economics of the instrument that we were going to use to transfer. So I've been watching this evolving differently. I haven't been watching the technology pull along the interest in use. I've been watching the needs of an industry calling for this development. And it's at 2 levels. What I call the micro level, the transactions that are needed to be done quickly and cost effectively and efficiently. And it's increasing. At first it was, maybe once every couple of months I'd get a call, hey, we've got this problem, this idea, and we were able to use digital assets to solve it. Now it's every day. And what I'm seeing at the same time is a growing recognition from the traditional providers that they're going to have to compete with this, because we are starting to work around the use of banks and banking rails and the traditional payment rails by using digital assets in different ways. And so what I'm now seeing is the evolution of the major players defending territory. This is going to move ahead rapidly. Why? Because the banks and the governments are going to make it move rapidly. They are going to take control of their portion of the business. And that's where we're going to see a lot of the next evolution. The banks are slowly getting the power to deal, particularly in stablecoins and particularly fiat-backed stablecoins. They're going to be able to collateralize loans against them. I spent a good part of my morning this morning working on a platform and program for the collateralization of digital assets and the use of stablecoins for the funding in and out of the platform. And so we're going to see a lot of it. So that's how I look at how this industry is evolving and developing. And the regulation is going to follow naturally, in my view. I will put my big prejudice out there. I personally believe that all that a digital asset is a representation of something we're otherwise using in other forms and have been using in other forms. And that therefore, I believe the regulation will follow usage and form as opposed to creating a sort of a whole new regulatory environment, if you wish. So we're going to see banking and banking law evolve. Securities may be part of it. I'm interested in what the payment systems are going to do. So to me, that's what's happening, and that's what's exciting, is people are starting to recognize that need and use is driving development, not that development is pushing for changes in regulation.
It's my interest. Yeah, I'll just introduce myself as well, and I'm kind of going to echo everyone's comments here. Brent Bowden, Chainalysis. I'm the country lead for tax policy, a little bit compliance, and the regulatory space. And I think when we look at stablecoins on the blockchain, and we see, I think one of the use cases that was mentioned, we see the inflows and outflows, right? So if we're going to a specific country, we start asking why, we start looking at trends and patterns. And one of the things that keeps coming up, especially for Canada, is that Canada has a lot of immigrants. And the question that we often ask ourselves is are they sending money back home? Are they sending money to support family? Is it in time of need? How best to do that? And I think that is probably one of the strongest use cases that we often question ourselves, right? It's like, we see this big chunk of money leave the country, where's it going to and why? And a lot of times just looking at the stats.
So again, the real need met by technology. Back to what Alison was saying is, are we seeing a move? You said compete. The banks and the traditional environment wants to compete. That word is strong. Is that an incentive to actually innovate on their front?
In my view, absolutely. What we've gone through in sort of the last 20 odd years is a massive debanking of very significant sectors of what would have been banking clients as a consequence of anti-money laundering and related regulatory issues and problems for the banks. They don't necessarily want to push a lot of those sectors out. They've had to do so because the cost of being able to maintain that customer base has simply become prohibitive once they get through the regulatory requirements, environments, and the costs of moving funds. The Filipino nannies one was very real. It was about 15 years ago, and we had absolutely no way because every single one of the money transfer businesses were effectively debanked in Canada, and so they could no longer provide those services. So the banks are going to need to see that what is happening is that the customer base that they debanked is actually eroding, and it's moving up and further upscale. The program that I was working with the clients this morning would be fairly substantial. The people who intend to participate in would be purely accredited investors, and it would purely, not because I need it, because it's not a security, but it would purely be that ilk. So once you start getting up into the very solid middle ground customer, you're getting into real money for them. You're getting into very real money. And so they're going to need to come back and be able to provide the speed, efficiency, cost efficiency, and the ability to regulatorily support the continued customer use of the banks. That's what I mean by competition. The answer is yes, it's going to drive innovation.
And we're on a panel on regulation, so we talk about general regulation or global regulation. Now, if we circle back down to Canada and this environment, where do we sit?
Canada appears to be evolving along the lines of a use recognition regulatory environment for stablecoins. I think Alex and I were both terrified about a year or two ago when it was looking as though the securities regulators were going to come in and attempt to scoop up the entire field and claim anything that was a stablecoin, regardless of structure or use, was a security. It appears that that view is adjusting, and it has to adjust, because the problem is if everything becomes a security, it won't work. It just quite simply won't work, because you can't use something that is found to be a security in a payment system or a trade payment or those types of things. So it's got to be recognized that the potential uses are finance, the potential uses are payment and payment rails, the potential uses include simple transfers, it can include simple money services. And so what Canada, I think, is slowly coming to that recognition, and I think that we'll probably go much more along those lines, which will be fairly consistent with the approach in a number of other jurisdictions, in my view. It also means we can actually get there, because if you try with the complexity of how stablecoins are being used to do it on brand new regulation, 30 years from now we'll still be discussing where the commas go in Regulation 407. So it's really got to go to that basis so you can take the existing regulatory, and that seems to be the way globally things seem to be going. I think, Alex, we've had this discussion before, and you tend to view it somewhat the same way.
Well, and just to make a little bit of a counterpoint, I suppose, on kind of the security side, there's a lot of really valuable protections, disclosures, and a lot of really valuable frameworks that come from that regime. And we were talking about it on the last panel of the way that the industry in general has been regulated in Canada is through the securities regime. Like the CTPs, the whole restricted dealer, that's how that exemptive relief was created, under the securities regime. And so it is a natural extension for that to be the first place that looks at value reference crypto assets, right? So there's a lot to build from and a lot to build around that structure, instead of, as you mentioned, creating something brand new. So I think I totally agree that use case driven, and when you think about this as a technology, not just a monolith, but I do think it's a natural place to start with securities law, and there's a lot of really good precedent to draw from there that gets to where we need to go. Because priority, again, 1, 2, and 3, and I say this all the time, is consumer protection, investor protection, and disclosure. And we just started regulating PSPs, like period, right? They used to be an unregulated entity. We've been regulating securities very well and aggressively for a long time. So does it make more sense to start with more disclosure for a new asset from an existing framework that has a lot to pull from? Our securities association has been working with the space quite collaboratively for a long time. So it is a natural evolution that's where some of this stuff starts as well.
So we've looked at different angles through the stablecoin for regulation. My question remains, is the future for a stablecoin infrastructure and a traditional infrastructure that has evolved? Is there a convergence? Which one goes to which? I assume there's no clear answer, but there's certainly opinions on what we're building.
I think that there already is a form of convergence. I really think that that's what you've got. I say to people when anyone gets mystified about what's a digital asset, I ask them a simple question to get it sort of simpler, straight for them. And I say to them, when was the last time you saw a share certificate? Just think about it. We've been using digital representations of things for a very, very long time. So I don't think the two are actually two different things. I think that they are simply a different method of delivery. And the methods of delivery, I think, are coming closer together. The very fact that, sort of side by side with stable coins, or in fact a form of stable coin, you're getting into the central bank issue. And, which was a natural evolution that I saw coming probably 8 or 9 years ago, which is that the central banks will never let this all escape. And the central banks will, in quotes, get into the business. So what you're slowly seeing is paper sort of disappearing in terms of payment and payment systems and value transfers in the same way that it disappeared sort of long ago in other aspects of our society. So I think we already have convergence. I think that what is going to happen is that some of the heritage systems are probably going to have to die and fade away. But I think the concept of simply using digital representation to move value and so on is already there.
Can I just actually ask you a question to take your, because a lot of this stuff comes down to, especially from the risk management piece to AML and how we actually manage this. If we're thinking about digital cash or an equivalent like that, how do we manage some of that? And obviously Chainalysis has played a huge role in that. And where do you sort of see your technology kind of mapping into existing frameworks for risk management, such that we can go with our hand on our heart to the largest institutions in the country and say, hey, we've solved this, and this. We have a fully, this is ready for scale.
Yeah, I'll answer that, and this is me speaking. I don't believe the guidance is there yet, right? From an industry's perspective, we can give the insight to it, but until the regulations are put in place, and I know you said it earlier, it's still early, we're still early days on this, but I think the industry, you're probably looking for that guidance, and it's not there yet. I think there's a proactive measure that some of organizations and companies are making, and I think that's what the best approach is now, just to be a little bit more proactive. And I think probably in 3 to 6 months' time, we'll be having a much different conversation.
Right. So actually on that one, it's actually very true. I think we actually, as an industry, we would actually love to work with Jonathan more regarding what would be the guidelines. So basically for any CTPs, when you're dealing with any crypto transactions, it doesn't even have to be stablecoins. As Jonathan has provided a lot of insights regarding, okay, whether there's any kind of scam percentage, sanctions, any kind of that, there's a percentage-wise, those based on wallet, based on the transaction hash, all kind of that stuff. But in the end of the day, it's a lot of information. When we have that information, 2 things were not clear is what's threshold? Is it like 0.1% with $2? We have to freeze the money.
Right.
And second is what's the actual action? So from the compliance perspective, any kind of, from an AML perspective, anything dirty, you should be freezing it and hand over to RCFP. But if it's only like $2 exposure, then what? So I think it's a lot of that things right now. It's actually at an industry player's hand, and we're actually rubbing our hands every day to decide what that threshold is. And I think all CTPs globally have that issues, and it comes to a company-wide risk decision. But I think that is not really good. We actually have to standardize that more or less.
I think for some people, I'm one of those people who likes to make things simple, because I understand it better if I make it simple, is that we came a huge way in the last few years towards the ability to regulate in the manner in which we as society have decided that we are supposed to regulate payments and payment systems. I mean, those of us who've been around for a while know that we didn't do any money laundering before 2001. So the fact that society has made that decision, I'm not even going to say whether it's a right decision or a wrong decision. The statistics are really out on that, but let's assume it is. Where the scare for the ability to be able to regulate wasn't so much around size and it wasn't around volumes. Where the concern was the initial indications that these transactions were going to be untraceable, that they were going to be opaque, that they could not in fact be tracked, because regulation around sanctions and anti-money laundering requires transparency and the ability to access and trace. What we have found now is with the change in sort of how things are being approached and the coins that are being accepted, whether it's cryptocurrency or whether stablecoins, what regulators have done is they've pushed this, whether visibly or invisibly, depending on how you're looking at it, they pushed it to a traceable, identifiable technology delivery system. And once you recognize that you can trace and identify, which you can do with the vast majority of systems that are now being approved, once you can do that, you can bring into play AML, sanctions compliance, bribery, in basically the same manner as you can do. It's just as easy to trace on-chain as it is to trace pieces of paper that are running around, they call them banknotes or cash. It's just as easy to trace that. So I think that was the big move. That was the big change, was going from this, oh my gosh, it's Wild Wild West, we don't know what's going on, to this is actually traceable.
Yeah, and maybe just to dig in on that, something that Shireen and I nerd out on sometimes is like the top down and bottom up like compliance approach to this, where we've historically, you sort of have almost privacy by complexity. Like it's very challenging to track, a dollar around a system, like a physical piece of cash. And so for blockchain, it's kind of the complete opposite. You can track literally every microcent around an entire network, but you don't really have the identity layer that goes to it. So in sort of more traditional types of money movement, you end up doing a lot of KYC and focusing on the user, the person, the ID, the habits, all of that, because you can't really necessarily see all of the everything that's happening from the actual dollars and cents perspective. And where we've kind of gotten to with blockchain is that we have top down where we have all the KYC, but we also have bottom up where we have complete traceability of wallets. And so you end up with a sometimes scary amount of detail on what's happening where and sort of the full transaction flow, and that's it's helpful to a certain extent from an AML perspective. I mean, sometimes there's a lot of information that comes attached to it, but it does open up a lot of kind of other interesting analytics like financial flows of assets. A lot of the stats that we've said we'd have to rely on Visa to tell us what their volumes are rather than being able to just say open up a block explorer. And so in some ways it's a bit of a whole new paradigm where we have this sort of unlimited visibility, but too much data is as bad sometimes as not enough data. So you end up with like data paralysis of like I don't even know where to start with this stuff. So it's as we get better and better at processing data and processing blockchain data, there's a whole new amount of frameworks for anti-money laundering and crime and terrorist funding prevention, but also for credit monitoring. I mean, when you're deploying assets into something, you can follow those assets in and learn what the platform's doing. Like there's a lot of visibility into what's actually happening on chain that I think that's going to be both a huge value driver, but also an opportunity for our friends here to help us process all this stuff.
As we're getting close to the question period, so get ready for the questions. We've talked about the Wild West and where we are today. Can we talk about Canada quickly for the next step, like actionable next step? Where would you like, or where would you hope it lands in the short term, call it short term, for our infrastructures on a system basis? Right?
Adam, you start those.
And give enough time for questions.
Yeah, I think just Canada in general, it's not a super big economy. So I think crypto asset stablecoin is a global, obviously digital assets. So I think the standards we're working on, and also obviously active work with security regulators, is obviously we're trying to find the balance between what is good for the US protection, but in the meantime, it's not isolate Canada from the global economy. So I think that is the really tricky part, and I think all the CTPs, and even maybe Alex, your company as well, is we're trying to find a good balance where US protection is up to standard, but also it's not going to create massive inconvenience to the user to use it, because payment side it cannot be too complex, right? So I think I'm hoping that I don't have answers. I'm hoping that there will be a balance.
Yeah, no, that's a fair point, and I think when you're competing with money, like money's pretty good, right? It's a pretty high bar to compete with. But I want to kind of take a step back as well, and everything that we've done regulation-wise in this country so far is really impressive, right? Like we've forerun the U.S. in many ways. We've created a functional framework for all of our exchanges. We have a lot of transparency and requirement. We have a lot of progress. A lot of our exchanges have gone through a new custom structure and gotten to a successful end. There has been sort of that evolution from restricted dealer into full CIRO membership on a couple of cases already. As the world has kind of gone from zero to something in stablecoin regulation land with MiCA and MAS and all of those things, and Canada has as well, and it's a natural bolt-on to the existing regulatory structure that has been successful with the CTPs. And so I think it's, progress is the most important thing in this, and lack of clarity and lack of, is it this, is it that, that's the killer. So I think we've done a great job of going from zero to where we are today, and I think that to me is sort of the key is continued evolution, continued collaboration, continue to get people through processes, continuing to launch new products that are compliant, that work with the regulations that are available to them, that are consumer protection, investor protection focused, all of that, and there's so much potential upside in this technology that we'll get to the efficiency side. Let's get to keeping people safe and keeping products that work right now, and we can optimize later, because this is a step function type of technology. It's not an incremental improvement from what we have. So let's keep people safe first, and we can grow the 1000x efficiency later as well.
Yeah, I just used a really good word there. I think keeping people safe is like the most underrated thought to this, and I think it often gets taken for granted. I don't know about you guys, but I think there's one or two words I keep hearing over and over today: collaboration, and just the overall education awareness. And I think for us to keep moving forward is that we're all going to have to learn how to collaborate even more than what we're doing right now. And that's from a private, public, all aspects. Well, CPS is here, Calgary Police Service, bringing in law enforcement, regulate. We just need to keep doing and keep pushing. And that will allow for further innovation. So that's what I want to see.
In my view, I would simply like to see Canada and its regulatory approach stay Canadian. And by that, I have a very specific meaning. Recognizing that Canada's regulatory environment, particularly when you're dealing with something that is effectively a payment or value transfer, has got to recognize global banking and global banking requirements, or else it will be ostracized. But within that, Canada has managed, over the last 46 years that I've been practicing effectively regulatory type of law, I've watched Canada be able to keep it real and keep it simple. I take, for examples, and these are the ones that sometimes make me laugh. I look at things such as, in Canada, to take personal property security takes 65 little sections in the Personal Property Security Act. The Uniform Commercial Code, Article 9, takes 1,700. They do exactly the same thing. I do cross-border. There is not once that I have a problem that comes up that I can't find an answer in those 65 sections that does the job. And by the time I finish rooting around in the 1,700 or whatever it is in the UCC, the problem's already sort of dead and gone, so it probably shouldn't have bothered in the first place. And you'll see the same thing. If I sit down and I write a prospectus for a Canadian offering, it looks pretty horrendous, and it's 150 pages. But if I go to do one in the US, it's like this, and that's on onion skin paper, guys, not on real paper. So Canada has somehow managed to be able to take a regulatory approach that makes things manageable and workable. And if you can't have a manageable, workable regulatory environment meeting our global requirements, then it starts to bog down. When they started looking at digital assets in the US, they wrote another entire section to the Uniform Commercial Code, and it makes absolutely no sense because all it talks about is technology instead of the use of the technology. So I'd like to see Canada and Canada's regulations stay Canadian.
To Mark.
I'll just speak live. Alex, this one's for you. I am optimistic on your point of view that maybe Canadian regulators won't describe stablecoins as securities. But I also, as a CTP, have been told explicitly they are securities. And I don't know whether that's right or wrong, and kind of analysis think that there's probably some path to safety there, and kind of carrying this whole chain to some extent. But I'm curious your point of view on what impediments that's going to create, because I couldn't even list UCAD today if I wanted to, because it's very important to my regulators.
This will be the 30-second answer to what is a very subtle question and what should have a very large and subtle answer. Number one, I do not think that the regulators are necessarily, they started with that as a position. I think it was from a lack of understanding of the use cases and the structures and manner in which particularly stablecoins, particularly fiat-backed stablecoins, were evolving in the market. The initial reaction was that, and some of the initial statements, if you read their introductory statements or in some of the initial papers and so on that were published, it talks in terms of use for investment. It talks in terms of investment type of language. And a lot of the reason was because the securities regulators were kind of first off the block to recognize that there are real risks and there is a public interest to protect. But they didn't stop to think that we already have a number of other regulators that are the appropriate regulatory environment for other uses. We already have a very extensive regime for regulated financial institutions, and the use of stablecoins by those institutions, particularly the issuance of them, is going to be very well regulated in the context of that regulatory environment. We already have consumer protection laws, we already have privacy laws, we already have laws that govern payment systems. And I think that I am seeing, certainly I'm hearing it in discussions I'm having, and Alex can comment as well because he's having even more than I am, that we're seeing a recognition that if they don't exhibit the use and attributes of the security, which requires effectively a form of investment purpose, it requires meeting the Howey test, which is that the payment is being made to another person with the expectation of profit based upon the management skills of that person. So when they realize that all that's happening is that stablecoin or other digital asset is moving from point A to point B to pay for a shipment of wheat, they realize that's not a security, there's immediate delivery. And if you read subtly what is being said and what's coming out, they are getting it. What is happening is there's a recognition it's likely not a security if there is immediate settlement, if there is an actual transfer of an underlying interest, etc. So I think we are going to get there, and I think we are getting there. And it does take going right back to first principles of what is a security and what isn't a security, and that's happening. Alex, I think you're seeing that too.
Yeah, I mean, I think I'll kind of say the same thing I said before, that there's a path forward that gets all of the protections that I think we all want and need, or I think and hope there is. And so, you know, I think there is a way to make this all work, I think, and you know that's what we're hopeful for.
Another question?
I think there's one more over here.
There's one, I think he had one first, and then,
You go for it.
sorry. And we have 3 more minutes, right?
Yeah.
Hello. So my question is, what would it take for assets an individual held on a personal wallet, more specifically like a Canadian stablecoin, unlike MetaMask, what would it take to get CDIC protection on that?
The ability of banks to deal directly in the underlying asset. CDIC ensures deposits placed with banks and some of the other affiliated regulated financial institutions. Some of the discussion that is happening, in fact, is that stable coins, if and when they're going to be permitted to be issued by the banks, will in fact be a representation of a deposit with the bank, will be treated in the same manner, which would give them CDIC coverage.
And just one additional point on that is CDIC often attaches at the account level. So yeah, a unhosted self-custodial wallet would struggle to fit anywhere in that framework, but an account with a regulated entity could, right? Like we're nowhere near that at all, right? Within kind of the current market dynamics and framework, but there does need to be that sort of account construct for CDIC, even to fit within the framework of how it's built today.
And there is some indication that there is a growing interest in the banks for this, in quotes, product. So I think it will happen in my mind undoubtedly within the next few years.
Yep. Next question. So my question is like, do you think we need the Canadian dollar denominated stable coin, or what is the potential?
No, it's a very good and interesting question, and you look at the vast majority of stablecoins today are U.S. dollar, 99.999%, and we've seen a lot of issuance of different currency stablecoins throughout the evolution of the market, and the majority of them have been issued and not done too much. To me, it really is the regulatory environment, the FX use cases, and treating them and connecting them to that fabric that is the international payment structure. So it's a lot more about the infrastructure that makes a stablecoin work than it is about the stablecoin itself. And a lot of that is the safety and security and how it's built. But a lot of it is sort of the payment rails that it goes into. If you create something that's a self-contained closed loop for a relatively small currency, then it takes time to grow that. When you start kind of connecting it to broader infrastructure, then there is more use cases, not just for Canada, but for multiple currency stablecoins globally. I wrote a paper with Cumberland a few months ago a lot about on-chain FX and sort of this use case in general. And so I think that's really where some of the demand and drive for non-US dollar stablecoins comes in. But again, I've said it a few times, I think it's kind of one of my running themes is it's early days. And so you look at the market cap or the issuance, and it is still a majority US dollars, but we're as much as we are adjacent to America, we're not America. And to piggyback on Allison's points, let's keep it Canadian.
Thank you.
Great, thank you very much. We're definitely out of time.